Hello friends, how are you? I hope you're studying well. Welcome to my new video in the economic series that I'm doing. Today we are going to study an important topic, that is GDP. We have already covered some aspects of GDP in our previous classes. If you haven't watched them already, then please do go and watch them, because without understanding those videos, it is difficult for you to understand this video, because this video is like a summation of all that we have studied till now. So please go and watch those videos. My name is Mohammed Yunus, and let us start with our today's discussion. Now, we have dealt with GDP extensively. First of all, let us understand what is GDP, and also understand why do we even have to worry about calculating GDP. Why in every newspaper, every day you will see that there is some talk about GDP, right? Either they are talking about the growth rate of India's GDP, or they are comparing India's GDP with the world GDP, or they're comparing India's GDP with Chinese GDP, or the GDP of other developed countries like US and UK and European Union and all. GDP is one of the important metrics to see how the economy of a country is doing. So basically, what is the total production of goods and services that is happening in a country is gauged by looking at the GDP of a country. For example, last year India produced 100 rupees worth of goods. So if this year we produce 110 rupees worth of goods and services, then we can say that India's GDP is growing at 10%, right? So that is the meaning of GDP. It is the total production of goods and services which is happening in a country. Now, why do we have to worry so much about GDP? Why do economists and international organizations like IMF, World Bank look at a country's GDP to understand its growth trajectory, right? Because everything else follows from GDP. If there is more production of goods and services, it means country is employing more and more people, right? For producing goods and services, you need people. So if there are more people being employed for producing goods and services, it also means their incomes are rising. So it indicates that a country is growing. A country is progressing on economic path. That is the first importance of GDP, right? The second importance of GDP is that by understanding what is the GDP of a country, central government and RBI are able to frame policies better. For example, central government depends on taxes, right? Taxes is one of the main sources of revenue for the government, right? And as the income of the people increases, when does the income increase? When GDP increases, right? When there is more production of goods and services in the country, then people's income increase. When people's income increase, then obviously taxes will be paid by the people and government's revenue increases. Hence, tracking GDP is also important for the government to set its taxation rate and also expect what is the revenue that we are going to get this year. And next, after that, government will be able to plan how they are going to spend that money, on which scheme, on what project, and how much they are going to give it to the states, and how much they are going to invest in defense expenditure and all. So all of this calculation of the central government and state governments as well depends on what will be the total production of goods and services in the country or in state, right? Now, how does it help RBI? Like, what is the GDP of the country and all? How does it help RBI? Now, who prints money in our country? It is RBI, right? Notes of denomination 2 and above are printed by RBI. Coins and rupee 1 note are printed by the government of India, right? So how does RBI know how much notes to print? When the economy of a country is growing, people need money, right? For example, last year if we produced, let's take the previous example. Last year if we produced 100 rupees worth of goods, and this year if we are producing 110 rupees worth of goods, now what is the total demand for money? 110 rupees. Last year if the total money in circulation was 100, then this year the money in circulation must be 110, right? So 10 rupees must be printed by RBI. So this calculation of how much money to be printed and what is the total amount of money in circulation and what is the total money supply and what are the different aggregates like M1, M2, M3, M4 that we study in future videos, all those things are dependent on calculating and tracking GDP. So understanding GDP is important for many reasons, right? It also gives you what is the health of economy. For example, if last year we produced 100 rupees worth of goods and this year we are producing 90 rupees worth of goods, then it shows that production is declining. When production is declining, it means less and less people are being employed, right? So if less people are being employed, then total income of the people is declining, and if income is declining, then obviously expenditure will decline. Can you see what is happening here? This is called vicious cycle. Just because of decrease in GDP, maybe you can take the example of what happened during COVID-19 time. During 2020-21 financial year, GDP went into recession, right? For 2 consecutive quarters, India's GDP was in negative. That is the definition of recession, right? So because of that recession, India had to face a lot of problems, right? And to come out of that, government had to push a lot of schemes in order to revive the demand in economy. Now, how demand is important and what is the role of demand in today's modern industrial capitalistic economic system, please watch my previous videos. There I have dealt with this in detail. So in order to predict any changes in the economy, or in order to predict any negative turn that is going to happen in economy, economists as well as government, including RBI, will keep a close eye on what is happening with GDP, right? So this is the reason for studying GDP. Now you must have already seen this picture in my previous videos, right? This is a simple explanation of something called as circular flow of income, right? So what is circular flow of income and all that we have already covered in my previous video. Here I'll just give you a brief summary of it, right? Circular flow of income helps us understand how the money moves in economy. If you see the economy of any country or any town or any state, you will see that there are mainly 2 actors. One is there are firms which are producing goods and services, right? Any firm. If you are producing something, you are also a firm, right? And there are households. Households means consumers. Like for example, I am producing this video, which is a service I am providing, and you're watching this video. So I am a firm here and you are a consumer. So in any economy, there are firms and there are households. Firms produce goods and services. Households consume goods and services produced by the firms, right? Now, in this circular flow of income, we have already studied that there are 3 methods of calculating GDP, right? At point B, if we calculate GDP, that is the total worth of goods and services, then this type of GDP is called as GDP by product method or GDP by value added method. And if we calculate the GDP at point C, right? Point C is the total payment received by the factors of production. So this is the income of the factors of production. So if we calculate GDP at this point, then you know what is this? This is GDP by income method. And there is one more point where we can calculate GDP, right? And that point is A. Now, the amount that households receive, they spend it on goods and services, right? The amount that you are receiving, you spend it on some goods and services. And all the expenditure of all the consumers, if we calculate that expenditure on the final goods, then that type of calculation gives us GDP, and that GDP is called as GDP by, correct, expenditure method, right? Now, how these things work and what is the importance of circular flow of income, I have already made a separate video on this. Please watch that video and then you can watch this video. That will make things clearer for you. Okay. Now, these are the 3 methods, right? Now, let us see one by one in some detail. The first method is GDP by product method or value added method. Now, let's say you are staying in, let's say Mumbai, right? And if you want to calculate what is the GDP of Mumbai by product method, then how can you do that? You just have to find out what is the total amount of goods and services which are being sold and bought in the market, right? You take into account all those goods and services and then find the monetary value of those goods and services. For example, a doctor giving advice, he may be charging you 800 rupees. So that 800 rupees you have to take into account, right? And doctor has prescribed your medicine, that is a good, right? And you buy that medicine and the medicine, the value of that market value of that medicine is rupees 500. So you take into account that 500. So like this, monetary value of all the goods and services produced in Mumbai will be taken into account. Now, one important thing that many students, many aspirants of competitive exams forget is that when you are calculating GDP by product method And if there is a question in your exam and which says that it is the monetary value of all the goods and services produced in economy in a given period of time, then that definition becomes wrong, because here we are not going to take the monetary value of all the goods and services produced in a period. We are going to calculate the monetary value of only the final goods and services. Why final goods only? Why not intermediate goods? And what are final goods and what are intermediate goods? I have already discussed these things in detail in my first video. Please watch that video. So this is the basic definition of GDP by product method, right? You take all the products and services produced in an economy in a period of time and calculate their market value. And you have to be very sure that you are taking only the final goods and services, right? And this has to be within a given period, maybe 1 year, maybe 3 months, whatever. And it must be within a particular geography. For example, if you are calculating GDP of India, then anything which is produced within the boundary of India, within the territory of India, will be part of India's GDP, right? There is one more metric called GNP, gross national product, which is different from GDP, that we will study in the next section of this video, or probably in the next video. Now, I told you that GDP by product method is also called as GDP by value added method, right? And what is value added method? We have already discussed. Now, if we calculate GDP by value added method, then what will be the definition? We have to calculate the gross value added by all the firms in economy. Now, the word that is to be focused is gross value added, right? Now, what is gross value added? Gross value added simply means total value added minus value added by intermediate goods. So, like how we took only final goods while calculating GDP by product method, we will take the value added in the final good. What is the total value of that final good, right? Hence the term gross value added. So we have to deduct value added by intermediate goods from total value added to get gross value added. So this is the definition of GDP by product method or GDP by value added method. I hope you have understood this. If you are facing difficulty, then it might be because you are not familiar with the terms what is value added, or you might not be familiar with the term what are intermediate goods and what are final goods. For that, please watch my previous videos, then it will become very clear to you. Now let us come to the next method of calculating GDP, that is GDP by expenditure method. Now what is expenditure? It is the total expenditure undertaken by different actors in economy. Right. Now, if we look at, for example, Indian economy, how many actors do you usually see? First is households. And households undertake what type of expenditure? Households usually undertake consumption expenditure. We consume. We spend money on different goods and services. That's what we do, right? But apart from consumption expenditure, we also invest money on fixed capital. Like, for example, buying a house, constructing a house. But that is also part of households expenditure, right? So the first actor which undertakes expenditure in economy is households. And what type of expenditure households undertake? Consumption expenditure. And the symbol which is used to denote this is capital C. Now, which is the second actor in economy? Second actor is firms, right? The factories and service centers and hospitals and restaurants and everything, right? All those firms which are producing goods and services are part of firms. Now, what type of expenditure firms undertake? They mainly produce goods and services, right? So firms mainly undertake investment expenditure. They invest in the capital goods to produce goods and services. And the symbol used is capital I. Now, tell me which is the third important actor in economy after households and firms. It should be very clear to you. The third important actor is government, right? Now, what type of expenditure is undertaken by the government? First is consumption expenditure. Government also undertakes consumption expenditure. Why government undertakes consumption expenditure? Because see, government has a large administrative machinery to run. Right? It has all India service employees, it has central government employees, it has defense employees, it has a lot of public sector undertakings, It is running railways, postal services, and all those things. Government has to pay salaries to these employees and pensions to these employees, right? So that type of expenditure is consumption expenditure. Apart from that, government also needs a lot of goods and services to run this mammoth administrative machinery, right? So first type of expenditure which government undertakes is consumption expenditure. Now, don't you think government also invests money for capital goods, right? Government builds roads, ports, highways, airports, all these things. This is called capital expenditure. So government undertakes mainly two types of expenditure. One is consumption, second is investment expenditure. And all of this is combinedly referred to as government expenditure, and it is denoted by capital G. Now, some of the goods and services produced in India are exported out of the country, right? We export a lot of goods and services to US, European Union, Middle Eastern countries, Southeast Asia, and SAARC region, right? So that export, what is it? It is injection of money into the circular flow. How it is injection of money into the circular flow? To understand this, please watch my first video, right? Now, exports bring money into economy. Why? Because when we sell goods to people outside the country, they give us money for purchasing that goods and services. So that money becomes part of India's money supply. But India not only exports, imports goods also from many countries. When we import goods, we have to pay them, and when we pay them, this is the ejection of money from money supply. Meaning the money which was part of India is going out now to other countries because we are importing goods, right? So when we are calculating GDP using expenditure method, what we do is that we add the money which is coming into India through exports, and we subtract the money which is going out of India through imports. And when we do that, the measure that we get is called net exports, and the net exports is denoted by capital N. So these are the basic components which form part of GDP using expenditure method. Now what we do to calculate the GDP using expenditure method, we simply add all these things. What is the total consumption expenditure of the households? What is the total investment expenditure of the firms? What is the total expenditure by the government? And what is the total income through net exports? See, it's a very simple thing. You must know that a country which has more exports than imports, its GDP will be higher. Why? Because there is more money coming into the economy. A country which imports more than exports will be eventually having its GDP decline because money is continuously moving out of the economy, right? Now, let us find out the formula for calculating GDP by expenditure method using these variables or using these components. The formula is simply C plus I plus G plus exports minus imports, and exports are denoted by X and imports are denoted by M. Now, what I just told to you about exports and imports will be very clear to you if you look at this formula. Now tell me what happens if consumption expenditure of the households goes up. What happens to GDP? Obviously GDP will increase, right? More consumption, more production of goods and services, more employment, more income, more expenditure. You see how this is called virtuous cycle. Similarly, what happens when investment expenditure of the firms goes up? Obviously GDP will increase. What happens when government expenditure on investment and consumption goes up? Obviously it will also help increase GDP, right? Now what happens if exports increase? GDP will increase. If imports increase, GDP will decrease, because this becomes negative if imports increase, and this must be deducted from this expenditure, right? So this is a very, very simple explanation of what is GDP by expenditure method. Now if you look at textbooks and NCERT, the definition given is it is the sum of the final expenditures received by the firms. Now the important term here is firms. GDP by expenditure method is defined as sum of the final expenditures received by the firms. So what are the final expenditures that are part of GDP by expenditure method? Consumption expenditure by the households, investment expenditure by the firms, and expenditure by the government, and net exports, right? Now why are we saying these are received by the firms? See, when you spend on goods and services, who is receiving your expenditure? Obviously firms which are producing those goods. If you buy mobile phone, who is receiving that expenditure of yours? Obviously mobile phone manufacturing company, which is a firm, right? And if you go to a hotel and eat idli dosa, so who is receiving the expenditure that you made on idli and dosa? Obviously the person who is running that restaurant. So it is a firm. So all your consumption expenditure is being received by the firms. Now when firms undertake investment expenditure, what is investment expenditure? I have already discussed in my previous video. So investment expenditure is basically investment on capital goods, the goods which are used for production of other goods and services, machines, tools, right? Roads, bridges, vehicles for transportation of goods and services, buildings for establishing factories and all. Now when firms do investment expenditure, they have to buy goods and services, that is capital goods, from some other firms. So when one firm buys capital goods from another firm, basically this is also a firm, hence the firm is receiving the expenditure of this firm. Now when government consumes, it buys goods and services from some firm, and when government invests, again government buys the capital goods from some firms. So you see, all these expenditures are finally reaching one or the other firm, either in India or abroad. Hence, the definition of GDP by expenditure method says that it is the sum of the final. Now again, the word final is important here, because we do not include the expenditure received by the firms on intermediate goods and services. We only include the expenditure which is received for final goods and services. One important concept related to this that you must understand is that aggregate demand. Now, at the risk of sounding repetitive, I am telling you again, I have already discussed what is aggregate demand in my previous video. So please watch that. This is just an introduction to what this aggregate demand is. Now tell me one important thing. The consumption expenditure that you are undertaking is going to a firm. Investment expenditure is also going to a firm. Matlab, it is being finally received by the firm. Government expenditure is also going to the firm. Meaning, when all these expenditures reaches firms or companies, what indication it is going to the companies? That there is a demand in the economy, right? Hence they need to produce more goods and services to fulfill this demand from various actors in economy. So can we say that by calculating GDP by expenditure method, we will know what is the total demand or aggregate demand in the economy? Because when we calculate all this, it will be same as total demand, because demand is exactly equal to expenditure. For example, if you demand 2 packets of biscuits, then you will spend that much on 2 packets of biscuits. So aggregate demand can be known by calculating GDP by expenditure method. Hence, if you see, the formula for calculating aggregate demand is same as formula for calculating GDP by expenditure method. So if you want to know what is the aggregate demand in the economy, whether there is a demand for goods and services, see why we need to know what is the aggregate demand in economy? Because demand is directly connected to employment and income of the people. Because if the people are earning more, then there is more aggregate demand. For example, during COVID-19 time, aggregate demand fell sharply because people's income fell sharply. When income falls, aggregate demand falls. Hence, you can say that GDP by expenditure method gives us demand side of the economy. So, by calculating GDP by expenditure method, you can know what is the total aggregate demand in the economy. So this is a brief introduction of what is GDP using expenditure method and what is aggregate demand and how GDP by expenditure method is same as aggregate demand. Even if you read newspapers and all, when National Sample Survey Office NSSO conducts expenditure surveys, by doing those surveys, NSSO is trying to find out what is the aggregate demand and what type of goods and services are being demanded by the consumers or households. So aggregate demand can be known using GDP by expenditure method. Now let us understand one more concept which is connected to GDP by expenditure method. Now, as I told you, the formula for calculating GDP by expenditure method is consumption expenditure by households, investment expenditure, government expenditure, exports minus imports, right? Now, if consumption expenditure goes up, GDP will go up. But the question that should come to your mind is, what is the result of this? For example, if people are consuming more, then GDP will go up surely. But is it sustainable? Is it the correct model of economy that we must follow? Should people spend more and more on consumption goods? Let's say that consumption expenditure is increasing, but investment expenditure by firms is decreasing. right? Now GDP will be same because one is increasing, one is decreasing. It will not have an impact on GDP. But eventually country will suffer. Why country will suffer? Because investment expenditure is something that is undertaken for manufacturing or buying new machines which will help in the production of other goods and services, right? If firms buy new machines and invest in expansion of production, then production will go on increasing. But if firms are decreasing investment and we are spending more and more on consuming durable and non-durable goods, then what happens? Eventually, India will not be self-sufficient. India will have to depend on more and more imports to satisfy its demand for consumption expenditure. Why? Because we are not focusing on investment expenditure. We are not focusing on capital formation. We are not focusing on fixed capital formation or gross capital formation. That is why if you look at newspapers and budget documents and all, government stresses more and more on increasing investment expenditure because this is how we will grow. If we keep on increasing consumption expenditure, in the short term we might feel that economy is growing, but eventually we will run out of machines which are required for production of these goods and services. Hence we will have to depend on imports. If India wants to become Atmanirbhar in the production of goods and services, then what must increase? We must increase investment expenditure. And consumption expenditure is also necessary, but at the same time, investment expenditure must also go up. Currently, if we look at India's total expenditure, or if we look at GDP by expenditure method, then you will see that India is largely a consumption based economy. I will show you a chart from Economic Survey. You will see that most of our GDP is coming from consumption expenditure. So this is the chart from Economic Survey. You see, these are the components of GDP by expenditure method. So this is the growth rate and this is the total contribution by that variable or that component. So as we have seen, this is total consumption. That is government consumption and private consumption. Now, private consumption is denoted by C, government consumption is denoted by G. Now, next is fixed investment, that is investment expenditure which is undertaken by the firms, which is denoted by capital I. Now, don't worry about change in stock, variables and all. That is not necessary for competitive exams. Now, let us understand the next variable, which is exports of goods and services, which is denoted by X. And next is imports of goods and services, which is denoted by M. So as we saw in the formula, it is G plus C plus I plus X minus M, right? Now let us see the components. The first thing is government consumption expenditure and private consumption expenditure. We will focus on private consumption expenditure. See here, in 2018-19, right? I have taken 2018-19 because after 2019, there are a lot of variations because of pandemic. So I have taken a year before pandemic, right? Now, what is the total consumption? What is the contribution of consumption in the total GDP? 70%. Almost 70% of our GDP is coming from consumption expenditure. And what is the percentage of household consumption expenditure? Almost 60%. So 60% of our economy is coming from consumption expenditure. And what percent of economy or GDP is coming from investment expenditure? That is fixed investment, 30%. This is not bad, but if we want to go on increasing and become one of the leading economies of the world, then we must also focus on increasing our investment expenditure. See, India is called one of the largest markets in the world. Why? Because of this fact that we consume a lot. Hence, different companies wants to come in India and establish their factories or outlets. Why? Because there is a lot of consumption in India, and India hence is called as one of the largest markets in the world. And what are the total exports? 19% and imports 23%. You see, we are actually losing, right? Because there are more imports than exports. So we have to deduct this net from this. Hence our GDP will decline because of excessive imports. Hence we should focus on increasing our exports. And if you have watched my previous videos, then you will know that exports are directly connected to investment expenditure. As the investment expenditure go up, exports will also go up, right? So this is the basic understanding of what is GDP by expenditure method. Now the third method of calculating GDP is income method. It is also called as factor earning method. Why it is called as factor earning method? Because we simply add the income received by 4 factors of production. So which are the factors of production? We have labor, we have capital, we have land, and we have entrepreneurship. So these are the 4 factors of production. And each factor of production provides a specific factor service. And for providing that factor service, it receives a factor payment. And that is called as factor payment or factor cost. And what is the factor payment received by labor for providing its factor service? Wages. And it is represented as W. What is the factor payment received by land for providing factor service? It is rent. And capital receives interest. Right? And entrepreneurship, the person who owns the factory, he receives profits, and it is represented as pi. Right? And here also, while calculating GDP by income method, we include exports and exclude imports. Hence the formula for calculating GDP by income method becomes, that is, wages, rent, investment, profits, exports minus imports. Right? So if you're preparing for competitive exams, you don't have to worry about these symbols in this method or in the previous method. You don't have to worry about exact nature of the formula. What you should know is that what components are part of different methods of calculating GDP, because UPSC might simply give you a sentence which might exclude one of these and you are asked to find out which is the correct or wrong. If anything is excluded from this, that statement or definition of GDP becomes wrong. Right? So this is a very simple understanding of GDP by income method. Out of 3 methods of calculating GDP, most important methods are GDP by product method or value added method, because that is used by many countries to calculate GDP. In newspapers also you will see that value added is used multiple times every day. Okay, and the next important method is GDP by expenditure method. That is also used by many countries, and that also is very, very important. GDP by income method, you must know what is the meaning of GDP by income method. No need to go into detail. So these are the 3 different methods of calculating GDP. Now let us understand one important concept. This concept is not given in your NCERTs, but this concept is essential to solve a lot of questions which are asked in UPSC or other competitive exams related to economics. Right? Now, what type of activities are part of GDP and what type of activities are not part of calculating GDP? So when you want to know what type of activities in the economy which are part of GDP or which are calculated in the GDP, you should focus on 2 important things. One important thing you should focus on is that, is there any buying and selling of that good or service happening in the economy? What should happen? Buying and selling of that good. So this is the first thing you should focus on. Why you should focus on this? See, there are a lot of things in economy which are not calculated or which are not included in the calculation of GDP. Right? For example, let's say you hire a maid to work in the house. Right? Now she is coming and providing service in your house. You pay wage to that maid, right? And this, what is happening here? There is buying and selling of service. She is providing a service to you. You are paying wages to her. Hence, that service which she provided will be part of GDP calculation, right? But if you clean your own house, is there any buying and selling of goods and services happening when you clean your own house? No. Right? So then it will not be part of GDP. Very, very simple. If you call urban company to clean your house, then it will be part of that service or the transaction which happened. The money you paid to the urban company will be part of GDP. But if you decided that on a Sunday I will clean the house myself, so that service that you are providing to yourself, basically you are consuming your own service, right? You are not selling it to any other person. That will not be part of GDP. For example, if you put your child in some daycare center and you are paying for that service, what happens now? Now that service being provided by the daycare center will be part of GDP. But if a mother is taking care of her child, there is no buying and selling of service here. It is care economy. Mother is taking care of her own child. Then that care economy will not be part of GDP. This looks unfair, but that is how GDP is calculated. right? So first you should focus on whether there is a buying and selling of that good or services happening or not, right? Second thing you should focus on is that, is there any transfer of goods and services? See, what is buying and selling of goods? It is a two-way process. One, you pay money and then you receive goods. This is what buying and selling of goods and services, right? So this is an economic activity. There is a transfer of goods and services and money. But sometimes there is one-way process. There is only transfer of money. There is no transfer of goods and services. Can you name some activity which is happening in economy which is just one way? Yes, the government transfers. For example, the transfer payments made by government. What are transfer payments? For example, you receive scholarship for higher studies. Are you supplying any goods and services to the government? No, this is a one-way payment, right? And for example, old age pension. People beyond certain age receive pension from the government. Are those people supplying any goods and services to the government? No, they are receiving money because of certain reason, right? That is one-way transfer. You must have heard about PM Kisan scheme, right? Under that, every farmer gets 6,000 rupees in 3 installments every year. Are farmers supplying any goods in return for that to the government? No, this is one way. So any kind of one-way transfer. For example, the gift that you receive from your dad, right? That is a one-way transfer. You are not supplying any good or service to your dad. So then all those type of one-way transfers where there is no transfer of goods and services, only there is a transfer of money from one person to another person, that will not be part of GDP. So the transfer payment done by government will not be part of calculating GDP. So these two criteria you must remember if you want to know which activity will be included in calculating GDP and which is excluded while calculating GDP. Now let us see some activities which are not included in calculating GDP. So what is not included while calculating GDP? First is sale of goods that were produced outside our domestic borders. If you look at the definition of GDP, it clearly says it is the market value of all the final goods and services produced within the borders of an economy in a given period of time. Within the borders of economy, right? So because there is one more metric, that is gross national product. So to differentiate between gross domestic product and gross national product, while calculating GDP, we focus on only those goods and services which are produced within the borders of an economy. Like in India, within the territory of India. Right. Next is sale and purchase of second-hand goods. See, why second-hand goods are excluded while calculating GDP? Because they will have already been counted when they were produced for the first time. When, for example, a mobile phone is manufactured, then that will also already be part of GDP. But if it is being sold for the second time from one person to other person, then we cannot calculate it again because then that will be double counting. Right? So second-hand goods will not be part of GDP calculation. Third, as we discussed, transfer payment made by the government. Why transfer payment is not part of GDP? Because there is only one-way transfer of money. There is no transfer of goods and services in return for that money. Next is intermediate goods that are used to produce final goods. This is very obvious. Intermediate goods are not part of GDP. Only final goods are part of GDP. Investment in shares and debentures. Now, why investment in shares and debentures? You invest in stock market. That will not be part of GDP. Why it is not part of GDP? Because investment is a type of savings. So when you invest, is there any transfer of goods and services? Don't tell me that I receive stocks. Stocks are not considered as, or the shares or debentures are not considered as goods or services, right? So when you invest in any share or debenture, that will not be part of GDP, right? Next is windfall gains such as lotteries. Again, lottery. Is there any transfer of goods and services? No, you just take money because you have won the lottery. Hence, it will not be part of GDP. Domestic work done by women. All the work done by women at home from morning to evening, okay, that is not considered part of GDP because there is no buying and selling of goods and services happening. There is no transfer of goods and services happening, right? Hence, it is not part of GDP. Though there is a demand from various quarters to include this as part of GDP, then it will be a measure of improving the status of women. It will be like empowering women because then you will know the worth of services being provided by women, which is taken for granted in every house, right? Now, care economy, as we already discussed, a mother taking care of child. will not be part of GDP because there is no transfer of goods and services, or there is no monetary transaction which is happening for this service, right? Next is ecological services. For example, river which is flowing in your town, it is providing a lot of ecological services. It is providing clean water, it is providing a way to deal with floods, it is cleaning your city, it is, a lot of services are being provided, but it is not part of GDP calculation, right? But nowadays, a lot of different measures have come, like green GDP and other such measures, which are taking into account the ecological damage done to the environment while producing goods and services. Next is capital gains. Now, what is capital gain? You will study while understanding capital markets. Capital gains basically means, for example, you bought a land for 10 lakh rupees and now you are selling it for 15 lakh rupees. That 5 lakh profit that you got is called capital gains. So capital gains, which is a profit, but still this capital gain which is happening because of the increase in the price of the assets will not be part of GDP. So these things you have to remember, but there could be many other points which might not be part of GDP. For to understand or to recognize those activities, I have given you 2 criteria, right, in my previous slide. So remember those 2 criteria. It will be easy for you to eliminate options if such a question comes in UPSC. Now, these are the things which are not part of GDP, right? But there are certain things which are part of GDP but are confused to be not part of GDP. Let us understand which are those things. First is informal sector activity. Now, what is the difference between a formal sector and informal sector? We will study later in detail. But for the sake of understanding, any firm which employs less than 10 people is considered informal. A garage on the road, right? A small tea shop, a pawn shop, right? It mostly contains MSME sector, right? Micro, small, medium enterprises. But MSME sector, is a very important sector of our economy. Almost 40% of our manufacturing GDP comes from MSME sector. Almost 40% of our exports comes from MSME sector. So do you think informal sector activity will then be excluded from GDP? No. Hence, informal sector activity is part of GDP. Okay. Now, activities in Indian embassies abroad. Now, this must be confusing for you, as I just told that anything which is produced outside the borders of the country will not be part of GDP, right? But now I am saying that activities in Indian embassies abroad. For example, let's say there is an Indian embassy in the US, right? Now, if you know different UN provisions and Geneva conventions, then you must know that this Indian embassy, which is located in the US, for all practical purposes, this will be regarded as Indian territory. US officials or US security agencies cannot simply enter this territory and do inspection or arrest or something like that. Right? Because this territory in US will be considered as Indian territory. Similarly, any embassy which is located in India of any other country will be considered as that country's territory. Right? Hence, any activity, economic activity, buying and selling of goods and services which is happening in this embassy of India in US will be part of India's GDP. Understood? Next, services on airlines owned by India. See, an airline called Air India, it is owned by Indians, right? Now, it might be flying in international airspace. Maybe this Air India is going to, let's say, UK. While going to UK, it will cross Indian territory and it will enter international airspace, right? So now in international airspace, there is buying and selling of goods and services happening, right? People who are flying will buy goods and services, lunch, dinner and all. So this buying and selling which is happening on an Indian airline will be part of India's GDP. Now, activities of Indian residents in international water. For example, there is an Indian ship which is sailing to some other place and it is in international waters. What are international waters? It's a very simple thing that according to UNCLOS, that is United Nations Convention of Law of the Sea, any territory beyond 200 nautical miles away from a country's borders will be part of international waters, right? So any economic activity undertaken by an Indian resident in international water. For example, there is a ship and there are Indian residents and they are selling some goods. For example, let's say they are running a restaurant in this ship, right? And this is in international waters. Now that service being provided by this Indian resident will be part of India's GDP. So these are economic activities which, though occurring outside the territory of India. Why I have included them? Because they are outside the conventional definition of GDP. Conventional definition of GDP says that economic activity must take place within the geographic boundary of India. But there are situations where economic activity is happening outside the geographic boundary of India, but still they are part of India's GDP. And these are those activities, right? So this is the end of this video. I hope you have understood everything that we have discussed. I have tried to keep it as simple as possible, but if there are any suggestions from your side to make these videos even more interesting and even more interactive, then please do write in the comment section. I will try to incorporate them in my next videos. So here we complete the theoretical understanding of GDP. What we studied in this video is general understanding of GDP, but how India actually calculates GDP, which method India uses. And there is one more important thing, that is, before 2015 India used to calculate GDP using some different method, but after 2015 the method has been changed. If you look at 2021 question of mains, then there is a question which has asked you to write the difference between the GDP calculation method before 2015 and after 2015. So understanding that also becomes important. Please watch, subscribe, like and share this video as much as possible so that everyone benefits out of this. So until next time, bye bye, take care.